Everyone seems to hate SCHD right now, and that's exactly why we need to talk about it, because whenever an investment goes from being everyone's favorite to becoming the market's punching bag, something interesting is usually happening under the surface. So today on Stock Perdictor, we're diving deep into the question everyone is quietly asking but few are brave enough to say out loud: is it finally time to buy SCHD? Not long ago, SCHD was considered one of the safest and smartest dividend ETFs you could own. Income investors loved it, long-term investors trusted it, retirees depended on it, and financial YouTube couldn't stop praising it. But fast forward to today and the narrative has completely flipped. People are calling it dead money, outdated, boring, inefficient, and even a trap. And when that many investors turn negative at the same time, that alone should grab your attention. So let's start with what SCHD really is, stripped of emotion and noise. SCHD, or the Schwab U.S. Dividend Equity ETF, focuses on high-quality U.S. companies with strong balance sheets, consistent free cash flow, and a history of paying and growing dividends. It's not chasing hype, not chasing tech trends, not chasing growth at any cost. It's targeting companies that actually make money and return a portion of it to shareholders, and that strategy worked beautifully for years. But lately, SCHD has underperformed, especially compared to the S&P 500 and flashy growth stocks. Interest rates rose fast, growth stocks dominated headlines, dividend stocks lagged, and suddenly everyone forgot why SCHD existed in the first place. People aren't patient, they chase what's working now, not what will work over time. One of the biggest reasons people hate SCHD right now is simple: performance envy. When investors look at charts and see the S&P 500 powered by big tech while SCHD just moves sideways, frustration kicks in. People start saying things like, why am I holding this when AI stocks are booming? And that's a very human reaction, but it's also the exact mistake that ruins long-term returns. Another reason SCHD lost favor is rising interest rates. When bond yields go up, dividend stocks suddenly look less attractive. Investors can get safe income elsewhere, so money flows out of ETFs like SCHD. But here's the key thing many people miss: rates don't stay high forever, and markets move in cycles. What's hated now often becomes loved later. Let's talk about dividend growth versus price action, because this is where most investors misunderstand SCHD. SCHD is not designed to wow you with explosive price gains in short periods. It's designed to steadily grow income over time, year after year, even through downturns, and that income growth often doesn't show up immediately in the chart, but it compounds silently in the background. If you zoom out and look past the last year or two, SCHD's dividend growth history is still impressive. The underlying companies continue to generate cash, keep payout ratios reasonable, and maintain financial discipline. That hasn't changed just because the ETF price stalled for a while. Now let's address the criticism that SCHD is too conservative, or too old economy. Yes, SCHD leans toward sectors like industrials, financials, consumer staples, and healthcare. And no, it doesn't heavily weight cutting-edge tech names, but that's not a flaw, that's the design. SCHD is meant to balance risk, stability, and income, not chase the next big thing. When markets are obsessed with growth, boring gets punished, but when volatility rises, earnings shrink, or sentiment flips, boring suddenly becomes beautiful. This is exactly what we've seen time and time again throughout market history. Investors rotate from growth to value, from speculation to cash flow, from stories to fundamentals. Another complaint is that SCHD dividend growth has slowed recently, and that's true to some extent, but context matters. Companies across the entire market faced higher costs, inflation pressure, and economic uncertainty, yet SCHD companies still maintained dividends without massive cuts. That speaks to quality, not weakness. What most critics ignore is valuation. SCHD is now trading at a much more attractive valuation compared to growth-heavy indexes. When you buy assets at lower valuations with solid fundamentals, future returns tend to improve, not worsen. Buying expensive popular assets feels good emotionally, but buying unloved assets is where real wealth is built. Think about it this way: people loved SCHD when it was more expensive and hated it when it got cheaper. That alone should make you pause. Smart investing often feels uncomfortable in the moment. If it feels easy and obvious, you're probably late. Now let's talk strategy. Is SCHD right for everyone? Absolutely not. If you're a short-term trader looking for fast gains, SCHD will feel painfully slow. If you're trying to beat aggressive growth benchmarks every year, you'll likely get frustrated, but if your goal is steady income, lower volatility, and compounding over decades, SCHD still fits that role extremely well. For younger investors, SCHD can act as a stabilizer alongside growth assets. For older investors, it can provide reliable income without selling shares, and for long-term investors, reinvesting dividends during periods of underperformance can massively boost future returns. The irony is that SCHD becomes most attractive precisely when confidence is low. Dividend yields become more appealing, reinvestment buys more shares, and future income rises. This is how income investors actually win, not by chasing performance, but by consistently buying quality when sentiment is weak. Another overlooked point is psychological discipline. SCHD helps investors avoid emotional mistakes, because predictable income gives you something tangible even when prices move sideways. That income can keep you invested during tough periods, while growth investors panic and sell at the wrong time. So is it finally time to buy SCHD? The honest answer is it depends on your goals, but from a long-term, valuation-aware, income-focused perspective, SCHD looks far more attractive today than it did when everyone loved it. Hatred doesn't mean something is broken, sometimes it means expectations reset too far. The market has a short memory, but fundamentals last longer than headlines. SCHD didn't forget how to generate income. Companies didn't suddenly become unprofitable. What changed was sentiment, and sentiment is the most temporary force in investing. If interest rates eventually stabilize or decline, dividend stocks regain attention, income becomes valuable again, and suddenly SCHD won't look so boring anymore. By then, prices may already reflect that shift, and the opportunity window closes quietly. The big question you need to ask yourself is simple: do you want to buy what everyone loves today or what everyone is ignoring? Because history shows that long-term investors are rewarded for patience, not popularity. On Stock Perdictor, we don't chase hype, we analyze cycles, and right now, SCHD sits right in that uncomfortable zone where negativity is loud, expectations are low, and quality remains, and for disciplined investors, that combination is often exactly where opportunity begins. This is not about guaranteeing returns, nothing in the market ever is, but it is about stacking probabilities in your favor, buying quality businesses at reasonable valuations, collecting income while you wait, and letting time do the heavy lifting. So whether SCHD becomes your next buy or simply a reminder of how sentiment swings, remember this: the market rewards those who can stay rational when others get emotional, and right now, emotion toward SCHD is extreme. If you found this breakdown helpful, consider subscribing to Stock Perdictor for more calm, long-term investing insights, because in a market full of noise, clarity is the real edge, and sometimes the most hated investment today becomes tomorrow's quiet winner.